Cash out refinance, how it works. What is a cash out refinance? Cash out refinancing replaces your current mortgage with another, bigger mortgage, allowing you to access the difference between the two loans, your current one and the new one, in cash. The cash amount is based on the value of the equity you've built up in your property. The money can go toward virtually any purpose, such as remodeling, consolidating high-interest debt, or as a down payment to purchase other real estate. How does a cash-out refinance work? The process for a cash-out refinance is similar to that of a regular refinance, a rate and term refinance, in which you simply replace your existing loan with a new one, usually at a lower interest rate or for a shorter loan term, or both. With a cash-out refinance, you also withdraw a portion of your property's equity in a lump sum. The lender adds the withdrawn amount, plus the outstanding balance on your original mortgage, and issues the new loan balance. Lenders generally require you to maintain at least 20% equity in your property, though there are exceptions, after a cash-out refinance. To do a cash-out refinance, you'll also need to pay an appraisal fee. Unless you finance these costs with the new loan, subtract these from the final amount of cash you end up with. Cash-out refinance requirements. Just as you did with your original mortgage, you'll need to meet qualifying criteria to be eligible for a cash-out refinance. These include credit score. The majority of cash-out refinance lenders require a minimum score of 620. The debt-to-income ratio compares your debt payments against your monthly gross income. For a cash-out refinance, many lenders set a ratio limit of 43% on your new loan. You'll need to maintain 20% equity in your property. Some lenders might allow you to borrow more, but keep in mind, some equity cushion isn't a bad thing. You don't want to end up underwater if the market changes and your property loses value. How much cash can you get with a cash-out refinance? While lenders typically allow owners to borrow up to 80% of the property's value, the threshold can vary depending on your credit score and type of mortgage, as well as the type of property attached to the loan, for example, a single-family, duplex or 3 or 4-unit property. Lenders who offer loans insured by the Federal Housing Administration, or FHA, sometimes offer an FHA cash-out refinance that allows you to borrow as much as 85% of the value of your home. Cash-out refinance loans guaranteed by the U.S. Department of Veterans Affairs (VA) are available for up to 100% of the property's value. Pros and cons of cash-out refinancing. Pros. You can lower your interest rate. This is the most common reason most borrowers refinance, and it makes sense for cash-out refinancing as well. Obviously, you want to pay as little interest as possible when taking on a larger loan. Your cost to borrow could be lower. Cash-out refinancing is often a less expensive form of financing because mortgage refinance rates are typically lower than rates on personal loans, like a home improvement loan or credit cards. Even with closing costs, this can be especially advantageous when you need a significant amount of money. You can improve your credit. If you do a cash-out refinance and use the funds to pay off debt, you could see a boost to your credit score if your credit utilization ratio drops. Credit utilization, or how much you're borrowing compared to what's available to you, is a critical factor in your score. You can take advantage of tax deductions. If you plan to use the funds for home improvements and the project meets IRS eligibility requirements, you could take advantage of the interest deduction at tax time. Cons of cash-out refinance. Your interest rate might go up. A general rule of thumb is to refinance to improve your financial situation and get a lower rate. If cash-out refinancing increases your rate, it's probably not a smart move. You might need to pay PMI. Some lenders let you withdraw up to 90% of your property's equity, but doing so might mean paying for private mortgage insurance, or PMI, until you're back below the 80% equity threshold. That can add to your overall borrowing costs. You could be making payments for decades. If you're using a cash-out refinance to consolidate debt, make sure you're not prolonging debt repayment over decades when you could have paid it off much sooner and at a lower total cost otherwise. You have a greater risk of losing your property. No matter how you use a cash-out refinance, failing to repay the loan means you could wind up losing it to foreclosure. Don't take out more cash than you absolutely need, and ensure you're using it for a purpose that will ultimately improve your finances instead of worsening your situation. You might be tempted to use your property as a piggy bank. Tapping your property's equity to pay for things like vacations indicates a lack of discipline with your spending. If you're struggling with getting your debt or spending habits under control, consider seeking help through a nonprofit credit counseling agency. Preparing for a cash-out refinance. 1. Determine the lender's minimum requirements. As you explore your options, take note of each lender's cash-out requirements. Most require a credit score of at least 620, a DTI ratio below 43%, and at least 20% equity in your property. 2. Determine the amount of cash you need. If you're considering a cash-out refinance, you're likely in need of funds for a specific purpose. If you aren't sure what that is, it can be helpful to nail that down so you borrow only as much as you need. For instance, if you plan to use the cash to consolidate debt, have a firm idea of what you owe. If the cash is to be used for renovations, consult with a few contractors to get estimates for both labor and materials ahead of time. 3. Prepare your cash-out refinancing application. Once you've shopped around for a few lenders to ensure you get the best rate and terms, prepare all of the financial information related to your income, assets, and debt for the application. Keep in mind you might need to submit additional documentation as the lender evaluates your application. The bottom line. 1. Cash-out refinancing allows you to turn equity into cash through refinancing your mortgage. 2. While you can't cash out all of your equity, the process gives you access to potentially a large sum without needing to sell your home. 3. The terms of your refinanced mortgage might significantly differ from your original loan, including a new rate or longer or shorter loan term. Be sure to like and subscribe to catch the next video from New Day Property Redevelopers.